Welcome to Talking Point. Joining us today is a very special guest, Unmesh Sharma, Head Institutional Securities of HDFC Securities. Thanks, Unmesh. Such a pleasure to have you today joining us. I want to start by keeping 2023 in mind, because when we started calendar year 2023, there was gloom and doom all around. There was an impending recession in the US. China was a bit of a concern. There were geopolitical risks. Crude was a worry. And the markets, despite all that, climbed a wall of worries to make new record highs. As we step into an event-heavy 2024 with elevated valuations and the common statement when we say, well, the market knows it all, how do you feel of this market move in this current calendar year? Are you as optimistic, or is it a corollary of sorts still?
So 2023 was actually a tough one for everyone. In fact, I remember reading an article very recently talking about how, more than 80% of the forecasters got it wrong, and that admittedly included us. We had assumed that it's going to be a single-digit kind of growth market, maybe even on the negative. I think the one big positive which emerged through the year was actually the strength of the US economy and all the benefits which came through with that. Having said that, just because that is a call which did not play out, that does not mean that we are not in a position to actually get a much clearer picture of where 2024 goes. Now, our base case for 2024 continues to remain a little bit of concern. Honestly, that is not because there are no positives which will come through this year. I think what has, however, happened is that a lot of these positives are in the price. And especially if you see this breathtaking rally, which which we think is more of a melt up, which happened since, December till today, whether it was the FPI flows or whether it was domestic flows, and you see the resulting impact on the stocks. We think that we have got on valuations and on, in terms of lack of triggers at a point where it's not going to be a very smooth ride from here for the rest of the year.
Unmesh, I completely agree. It's not going to be a smooth ride, but I just want to understand from you what investors should do, because I think it eventually all boils down to that. And I know it's not about building a tactical portfolio. It's got to be more strategy. It's got to be more structural. And of course, India structurally is in a bull run, which we all believe very strongly. October 23rd, when the market started moving up, there was some apprehension, and most people were sitting on the sidelines, or in some words, were sitting on some dry powder. If you missed that rally between October 23rd to, of course, up until now, what should investors do? If you see a correction, should they load up? Should they still sit on cash? Is a cash call even recommended at this stage when there's so much of euphoria in the markets at a broader level?
Yeah, so look, that's the billion-dollar question. Having said that, okay. So let me put it into context. This is a typical case of the last leg of the market rally for the short term. Okay, in that sense, what has happened is that the valuations are now at over 20 times on FY25 on the Nifty level. That is not to say that everything is expensive. What's happened is that there are pockets where valuations are still supportive even with the rally, which is like, for example, large banks, IT. We do like the OMCs, gas, some pharma names, okay? Having said that, what has happened now is that there are two legs which have led to this rally coming here. And, understanding why the markets come here is actually more important to then understand what then happens later. The first is that after the election results from the states in December, there now seems to be a mood amongst the FPIs that the election-related volatility, which was expected in 24, will not happen. In the sense that markets don't have political views, they like stability. Okay, so that's kind of something that market now believes. The second is that oil prices, despite all the problems that we have seen in the Red Sea and whatnot, and the geopolitical issues, are still below 80 even today. And to some extent, that is something which has caught people by surprise. And then there is the domestic flow of liquidity, especially in the mid caps and the small caps. Now, you put this into context. What is sustainable and what is not sustainable? Okay, look, FPIs also have other places to be. So what happens is that if you are overweight today in the Indian market with the market at 21 times on FY25, if earnings don't follow through, as we have seen, strong reactions in the last couple of days from some of the bank results as well, then there is obviously going to be some despair, and so money can be taken off the table because it can't be reallocated outside the country. So from that perspective, relying on the fact that continuous FPI flows is now a given the strong geopolitical situation and the twin deficit problem in the country, is not something that you can take for granted. The second, however, part is the important one, which is the domestic flows, because what's happening is that money, very similar to what happened in Hong Kong, China in 2006 to 8, is trapped inside the country. It's not so easy to leave the country. And if you're playing markets, unless you find another way, as in either you move that money to fixed deposits, or you are moving that money to real estate, or to move, run your own business, that money actually stays within the market. And which is why what could happen is that we could see this melt up kind of continuing in the small to mid cap. Having said that, if you put all this into context, what you will realize is that incremental triggers are only going to come from the May election, if there is a positive surprise, even though I think a lot of positivity is built in. And the second is that individual companies performing and giving you results basis which the premium multiple sustain. And this is where the difficulty happens. And which is why what we are saying is that the easiest way to play this is to get defensive on your portfolio. You may miss a few percentage points on the upside, but at 21 times when you are entering the market, okay, at least in the short term, you need to be very cognizant that either your time frame has to be so long that it goes through all this period and is able to price in 2 more years of earnings, which means that you could see a year and a half of no returns, and you should be okay with that. Or it could be a staggered approach, or the simple way is to take some money off the table from the small and mid caps, put it into the large caps, and then wait out this period and in a defensive kind of mode. As far as cash is concerned, because because you made that specific point, we don't ever in our model portfolio go beyond 5% cash, and that's not something we recommend to people in any case, because finally, markets are you have to participate in the markets to make money eventually. So from that perspective, I think a defensive stance is what you want to be in.
And Unmesh, I did hear you mention large cap might offer a better risk reward in that sense as compared to the broader market. So in terms of a portfolio call, would you be looking at a market cap focused strategy, or would it be sector wise focused strategy at this stage?
Sector wise, with a slight bias so the bias is towards companies which will have a lot more robust earnings and we believe and some valuation comfort. Okay, so this is the starting point. In general, we are not, our model portfolio is market cap agnostic, but given the fact that generally, because the participation among the FPIs was lower than the domestic, technically what seems to have happened is that there seems to be a valuation differential between as far as risk reward is concerned, between the large and the mid cap. So sectorally, yes, but within the sector, the way we are picking stocks is to look at where the earnings growth is more predictable and robust, given where the valuations of the market are. And coincidentally, we also find that is because of the technical reason where the large caps are. So it's not like we usually don't take a call between large cap and mid cap. What we do is that we look at earning certainty, and at this point in time, the comfort on valuations as compared to the predictability of earnings is largest in the large caps, and that is why we are saying this. And to reiterate, banks, information technology, OMCs, gas, and pharma is basically where we are seeing the most comfort at this point in time.
So, Unmesh, I'll start with IT because this is a question that's been bothering me for a few days now. Hope was all around when tech companies reported earnings. Now, of course, they had very low expectations, so they performed largely in line. Margins are improving, attrition is declining, commentary, we can both argue whether it was positive or negative. But if I look at history, calendar year 2022, when business was booming, margins were actually falling and attrition was at a multi-year high. The current situation is a corollary of exactly that. And history has shown that in the last 15 years, when tech stocks have done well and business is good, margins actually have not done so well. Margin improvement has come in largely on operational efficiency on back of anticipation of a potential slowdown. So do you feel like we are missing the woods for the trees when you looked at these 4 IT numbers and got so excited?
Look, I'll be honest. While it was a marginal positive surprise, I was also surprised by the quantum of the moves in names like Infosys, Wipro, and so on and so forth. But What I think is happening here is there are three things. Okay, one is that IT, very interestingly, is a tough one, and because the nature of the companies with their move up the ladder, especially now that you have cloud and uh, more ER&D component to these companies is very different from how it was 15 years ago. A lot of trends that you see in the past are difficult to extrapolate now. What is happening, however, is that the primary concern was that given the fact that the US and Europe is going through doldrums and the US Fed is trying to slow down the economy, what happens to demand? The counter to that obviously was that discretionary demand and move of cloud and all the structural themes which will look beyond these short-term problems, right? Now, what's happened is that the stocks were beaten down, and with a small amount of outperformance, they have been able to deliver significant returns. I think that also reiterates the point of where we are sitting in the markets, which is that small moves can lead to a lot of changes in this. As far as IT is concerned, the way we would play this is that we would keep a marginal overweight, because we believe that even if we do get into a situation where the US slows down, the numbers will be broadly robust. We believe that. The second is attrition is always a good thing for this industry. I think the slowdown in the startup economy, so as to speak, on the private side, is something which has led to attrition falling. In fact, one of the anecdotes I often tell my clients is that the fact that a lot of large companies are asking employees to work from office more, like 4 or 5 days a week, is a sign that it is slowly becoming an employer's market. Because I think maybe the capital availability to the startups has kind of started to slow down, and this is job market must be contracting basically. So in a sense, that is typically a good thing. Stability tends to lead to, over a period of maybe 2 years, you will start to see that impact on margins. So I think I'm giving you a lot of data points, but broadly what I'm saying is that the growth rates of the last decade are not something you extrapolate. The market is not expecting that. On that, we don't expect to see negative surprise. In fact, we may see some positive surprise. The slowdown concerns may not play through, and the costs will remain under control because of these attrition issues. So broadly, I think it's not a bad space to be. Of course, within IT, we also count in our model portfolio things like IT-related companies, like the exchanges, like MCX, for example, where we have an overweight position. So if you put all that into context, we are quite constructive on this.
So largely tech play. Unmesh, I'll just add to that. We saw those large 4 players reporting numbers. Any buy calls in the big 4 that reported earnings, and also in the broader market space, any preferences in the IT players?
We have in our model portfolio, we have an overweight position on Infosys and HCL Technologies at this point in time. LTI Mindtree is the other one, and the tech-related plays we have MCX. Basically, these are the ones which, as a house, we are promoting. Broadly, you will see they are also fairly good on terms of earnings delivery. The worst is behind them, and generally, I think valuations are okay.
So Infi, HCL Tech, LTI, Mindtree, and MCX are the 3 stocks that are part of Unmesh's model portfolio. We'll take a quick break. We'll come back. Unmesh, stay with us, and we'll continue our conversation, so stay tuned. Welcome back. You're watching Talking Point. We're in an exclusive chat with Unmesh of HDFC Securities. Unmesh, you also mentioned to me that pharma is something that is a sector you're overweight on. In this pharma space, are you more positive on the domestic branded players? So, companies like diagnostic chains, hospitals, or more export-focused companies? I know that there is not too much pricing pressure. Last quarter, the earnings were also pretty impressive. And the sector as whole has done well. So where would you place your bets? Domestic branded players or players with an export piece?
So, look, there are two things. One is, I'll have to unfortunately warn you that as of right now, because of a change in analyst, we actually have all these stocks under review. So I can't go stock specific. But what we do have right now is a 200 bips overweight on the whole pharma patch. And generally, what you will find is that actually there doesn't seem to be too much comfort on the domestic healthcare names. Even though we like these companies, a lot of them are ads, but we don't have them in the model portfolio because of lack of comfort on the valuation piece. And there is a mix of large caps. Our largest overweights being Alchem and Cipla at this point in time.
Right. And how can I not talk to you about banks on a day like today? We had numbers that came from HDFC Bank. Market seems a little too disappointed. Deposits haven't grown, and it seems like it's not just a problem with HDFC Bank, but this could be a problem persistent for most of the private banks in this quarter. We will, of course, find out as we progress with the earnings season. But what is the approach on banks? Valuations are compelling. These are solid banks. The management commentary may or may not be able to be blamed. But how do you feel about the banking space? Because you did say you're optimistic, and if you are, what are the picks? Is it the large private sector banks? Is it the PSU banks? And I'm going to throw in another angle here of capital market players, right? So your non-lending companies like an Angel One, Anand Rathi, ICICI Securities, which will be merged soon, JM Financial. So how does one approach the banking space as a whole? Because there's so much happening.
Okay, so look, let me start with a disclaimer that because I work for HDFC, I won't be able to comment on any specifics on the company. Having said that, what I can say is that very similar to what happened in IT, a slight move in one direction on commentary has led to a very significant move on the stock price, and that is something now is when with valuations at 21 times on the market, this is to be expected, and which is why we keep saying that robust earnings delivery is the most important criteria to buy stocks. So that's one. Second being, what is the read through for the others? Okay, and that is where I think let me put it in this way, which is what compliance allows me to say, is that why is the market reacting this way to this? The most important was that it just goes to show how tough the deposit environment is. And at the end of the day, if you extend that argument, if HDFC Bank, which is well known to have a phenomenal execution and deposit-taking machinery, is in a position of this type of deposit growth, then can the second-tier banks be in a position to not either lose margins or market share in this kind of environment? What does that then do to the growth outlook from a 12 to 18-month perspective? And that is something that is quite scary, because if and to some extent, given how aggressive SBI is in the deposit-taking market at this point in time, which is anecdotally proved to be true. So, with the largest bank on the street in terms of physical presence, SBI aggressive, and with this type of numbers coming through, what that effectively means is that the systemic growth concern will come, which means that the smaller banks will suffer more if this is what has happened to HDFC Bank. So that I kind of reconfirms our view that the larger banks will be okay. So while the bad news may have been broken by a large bank, we believe that, and maybe it may not happen this quarter, but what will end up happening is that the outlook for the next couple of quarters will become bleak, and which is why you can see that the banks are under pressure in general. And on top of that is this whole question about what happens when rates start to fall, with an unprecedented amount of loans now linked to the repo rate. Unlike before, where the transmission of rates was not as efficient as what it is today, and all credit to the RBI for that. So you put all this into context. The point is that the smaller banks, NBFCs, and obviously bottom of the chain being the fintechs, which are basically going to do lending, the cost, what happens to their cost? And if the growth is going to get constrained, then what happens to relative market shares? Generally, this is an environment which is better for the larger banks as compared to the smaller banks fundamentally. On top of that is this entire thing about the FPI flows, which I was talking about, and the relative valuations. So yes, stocks have fallen, but at the same point in time, if you're running a portfolio which is very heavy on the small and mid caps, this is the time to kind of go into that. Does that protect your portfolio returns? In an environment the way in which I'm talking about the market, there is a possibility that we may see negative returns for a few months. In that context, also, this is a right call to take because it kind of protects your portfolio in case of a downside. And if you are wrong and the market goes up, you will capture most of the upside in the large caps. And that is probably how we look at this. So if you look at our model portfolio, of course, we can't talk about HDFC Bank, but we are broadly, State Bank is there, Axis is there as an overweight, and amongst the smaller ones, again, among the smaller banks, the best deposit-taking franchise being Federal is there. So, and then of course, we like the life insurance names, which is another way to play financials, even though they are not banks or lenders. And capital markets, we have an overweight position. We don't cover all the stocks that you mentioned, but at the same point in time, we are quite positive because we believe market participation is a theme which is structurally going to continue for a long period of time, and that we are very excited about.
Unmesh, one quick sector that I want to talk about, and it's ancillaries as well, because we will manage to cover a few of the smaller spaces, is real estate. Does this look overbought to you after an 81% surge in 2023? It seems like the space has seen a change of fortunes, to say the least. Usually and historically, again, real estate prices, real estate as an industry really follows a very robust equity market and is always a sign of the equity markets topping up. Do you agree? And if that is something that we're thinking, then what's the outlook on real estate and the ancillaries as well? So maybe a cement, paints, infra, everything else that goes into it.
Okay, so look, and don't get me wrong, but this link between the real estate and the cycle and the equity cycle, so as to speak, is to a large extent a very strong Bombay bias, if I may call it that. There is actually, India real estate, and I used to cover real estate myself as an analyst back in 2006-7 up to 12, and what I think I've been observing what's happening, and this is also globally. The first is that the equity cycle is a lot shorter than the real estate cycle. The real estate cycle tends to long for very long periods of time. And real estate cycle starts with a lot of despair, first moves up on discounting, then moves up on volumes as the economy progresses, and then finally it ends with a longish kind of price cycle, which is where, now if you look at the way in which real estate stocks are valued, even though, EV per sales or EV per pre-sales and all that, but broadly the valuation is determined by what is the NAV of the companies, right, which is the asset value in the company. If you look at the asset values, the most amount of money is made when the prices go up because all of that is pure EBITDA. It just flows straight down to the bottom line. At this moment in time, we are actually in probably the early part of the second phase of this cycle, which means that you've gone from despair to normalization of volumes. In terms of the volumes, pick up from normal levels to abnormal levels is something where we are early stages of seeing. And then you will see the price cycle, which is where then the volumes start to dip, and then that's when the market starts to get concerned as to what happens. But at the same point in time, that is where peak valuations come through and the premiums come. At this point in time, we are far away from that. So if you look at it from the context of the 10-year cycle, of course, that is not to say that stocks will go up in a straight line with that. Of course, they will follow the market cycle. But structurally, there is a lot of legs in the real estate cycle. It's one of the key driving forces of the economy at this point in time. And the cleanup using RERA and GST and all this has really created the base to do this. Within this, we are most constructive on residential. Our model portfolio has a 200 bips overweight on SOVA, which is also one of our 3 key ideas for the year. I know that stock's gone up since we announced that this is one of our key ideas, but we still continue to remain positive on this name. We also have other buys in the name, which Parikshit, our analyst, has talked about. But broadly, we believe that real estate itself needs to be played. The ancillaries also we are positive on. So cement especially is a stock, while cement and building materials, we club it together. So we have an overweight on JK Lakshmi Somani. We have an equalish kind of weight on Dalmia Bharat. No, actually, it's an overweight on Dalmia Bharat. That's basically what it is.
Wow. Unmesh, it was so good talking to you. I'll hopefully try and catch you for a longish interview sometime soon. We're completely out of time on that note. We'll slip into break. We'll come back. F&O Spotlight, F&O Star Show on the other side. So stay tuned.